Hi, everyone. Thanks so much for coming and joining us today for this first series of Stump the Chump for Q1. We just wanted to hop on and say welcome. We're just going to wait for a few more people to join as we hit that noon hour. Thanks for spending your lunchtime with us.
So lunchtime, Katie, does that mean there's sandwiches?
Yeah. Well, maybe for me. Yeah, we should provide sandwiches.
Yeah. For anybody that knows me, I'm a sandwich head, so I could eat a sandwich any time of day.
So this is a new series that we're launching. You can expect these quarterly. So they'll always be branded as Stump the Chump. And this quarter for Q1 with these new tax regulations out, we're talking about mostly talking about Secure Act 2.0 and what the heck does that mean, and what does does that all entail, and what you can expect. So as we're going through this presentation, be thinking about what questions you want to ask the Chump. It doesn't have to be about Secure Act 2.0. This is kind of your time to have a live financial advisor. So don't feel limited to what we're talking about today. The stumpier, the better.
Yeah, for sure. Well, and as we go through, there's probably going to be some things that maybe cross your mind. And at the bottom of your screen, you'll see that there's a chat dialogue or a chat button. If you click on that anytime throughout our conversation, it'll come up with a chat box that you can type in any questions that you have, any comments. We'll try to look at those throughout the conversation today. Otherwise, we'll kind of open up the floor and see what we have as we get to Stump the Chump. So what do you think, Katie? Should we get started?
All right, sounds great.
So as Katie was talking at the outset, this is really kind of a look at what changes came through in the Secure Act 2.0. That it gets to be kind of a fairly dry topic unless you're an accountant, I guess, which I think we've got an accountant on with us today. So hopefully this will be more interesting for you. But as we go through this, what we find is that in Secure Act 2.0, we really saw an overhaul to the entire, I don't know, retirement planning kind of picture, probably more of an overall, Katie, than we've seen in a lot of years. And so what I've kind of coined this one, and I've heard it other places, I'm not the one that made it up, but what I've heard is this is kind of the Rothification, where as we go through, everything is really pushing towards Roth IRAs and how do we help people save more into Roths. So one kind of key characteristic. And what we found is there's probably 9 top things that we thought our clients in particular would want to know. This to kind of lay the groundwork, though, whenever legislation like this comes out, it goes through kind of 3 phases. The first phase is Congress has to draft the legislation, pass it, and then they send it off, obviously, to the president to sign it and ultimately make it law. But from there, federal agencies that are responsible for kind of implementing it have to come up with, okay, now how in the heck do we do this? And so a lot of this, we haven't gotten guidance from the IRS or the Department of Labor yet on how exactly they're going to do it. But know that that's kind of the next piece. So what we'll go over here are the things that actually changed. And then we'll probably have to have subsequent conversations as we see exactly how do they implement it and what do we, how are we going to execute on that? So, but at least this will be a good start for us to look at these first top 9 things.
Well, and I feel like it's important, like this doesn't really even apply to me all that much because I'm not this age, but I've heard it being talked about everywhere. So it feels like, hey, if we're hearing this from everybody, let's hear it directly from my financial advisor. So
yeah, for sure. Well, and what's crazy about it is that there are so many changes in here that really do affect people from all ages and all walks of life. So it's kind of which is probably why, in my opinion, it's as sweeping as it is and as big of a change as we've seen. Probably, I don't know for sure when I would date it back to, but probably maybe even back to 1998 when they first opened Roth IRAs and offered them. So it really is pretty broad and sweeping for sure. And as we go through this, as we mentioned, if you have questions, type them in the chat box at the bottom of the screen. But also know that we've got probably maybe 20 minutes, 30 minutes, something like that of kind of prepared slides. But then as Katie mentioned, when we open it up, just any questions that
get interesting.
Yeah, that's right. Any questions that come to mind. So so let's start talking first of all about this. There's a lot of talk about changing the RMD age. So RMD, if you're not familiar,
required minimum distribution.
That's it. You're getting it. And so basically what the government has said is that if you're going to have a retirement plan, and we're going to allow you to defer all these taxes. At some point, we want you to take the money out so we can get our tax dollars. But as people have lived longer, life expectancies have gotten longer, they're changing the ages in which you can get to take those distributions or are forced to take those distributions. And remember, it's required minimum, not maximum. So these are just the amounts that you have to take as a minimum starting at certain ages. And there's a bit of a sliding scale to this one. So the best way for me to kind of walk through it, I kind of have a chart. And if you kind of picture what's going to happen is it started, if you remember back before 1.0 instead of 2.0, you know, the original Secure Act, they increased minimum distribution ages from 70 and a half to age 72. Well, now they're increasing minimum distribution ages all the way up to age 75. But it's kind of like for people that maybe are familiar with Social Security, they did it somewhat similar to that, and there's a sliding scale. So when they started increasing Social Security age, they did it, if you're born between these ages, you get your full retirement is 66 in a month or what have you. This isn't quite that granular, but it is somewhat. And so if you have a piece of paper in front of you, you can kind of write down this chart. On the left-hand side, you can write the age in which required minimum distributions will start. And on the right-hand side, you can figure if I was born between, or if I was born at this time when my birthday is. So let's start with the longest one, the age 75. So if your birthday started in 1960 or later, then you're going to have to start taking minimum distributions at age 75. So if you look at the screen, it says, you know, age 75 in 2033. Well, we just did the math backwards and said, okay, well, you'd be about, have to start taking those. If you were born in 1960 or later, your RMD age is age 75. If you were born between 1951 and 1959, then your minimum distribution age is going to be age 73. If you're born between July 1st of 49 and 12/31 of 1950, your age is going to be age 72. And if you were born before that, July 1st of 49, you're at 70 and a half. So the 70 and a half, that's the same. That hasn't changed at all. And then when they increased it to age 72, that's kind of current, but then they introduced these other ages. And so know that if you were born between 1951 and 59, your age is going to be age 73. And if you're born from 1960 or later, it's going to be age 75. And so when we talk about that minimum distribution, do you know, Katie, what happens if you don't take it out?
My guess is, if this is just a guess, my guess is if you don't take it out, the IRS decides what it should be and takes that as a penalty.
So yes and no. All right. So the IRS.
Hey, you're the chump. You're supposed to stump. Yeah, don't reverse this on me.
I will try it if I can, right? See? Yeah. And so what happened in the past was, if you were supposed to take your minimum distribution, but you did not, then what would happen is you had to take the distribution, pay the income tax on it. But then if you missed it, you also had to pay an additional 50% excise tax, or penalty tax. And what that meant was, let's say I had to take $1,000 out. Well, they would force me to take the $1,000 out. If I'm in the 15% tax bracket, I'd have to pay 15% tax on that. But then in addition to it, they'd say you have to pay a $500 tax penalty because it's half of what you should have taken out, but didn't. It was a big penalty.
Yeah, that's a big penalty.
Yeah. But now what happened is, most of the time, if somebody didn't do it, they didn't do it just for an error. It wasn't like somebody was trying to get away with it. And so many times the IRS would say, that's fine, we'll give you an exception and we won't charge that tax. Well, what they're saying now is that they're going to reduce that. They're going to reduce that minimum, or that tax, to 25% if you don't correct it timely. But if you correct it timely and you say, hey, I'm sorry, I've had the money in an IRA, I'm going to correct it in a timely way, they're going to reduce that down to 10%. But what our assumption is, or what our thought is, they're going to stick with the 10%, right? So that what used to be a very significant tax that we did not see implemented very frequently, we probably go to a smaller tax, but you're not getting out of that one, right? You're going to be paying that 10%. And for most people, it's not a big deal. In the entire time that we've been in business, I can remember one time when somebody had somehow missed their first minimum distribution, and the IRS was very lenient with them. but other than that, it's not something that happens a lot. But if it does, you know that you got some
Do
protection there.
you want to ask me what 10% of $1,000 is?
What's 10% of $1,000?
$100.
Good job. We're not stumping that chump.
You know.
So the next one is what used to happen was if you had a Roth IRA that was inside of your 401k or your what we would call an employer plan, you would have to, when you hit retirement or hit minimum distribution age, you would be forced to take minimum distributions on that Roth account as well. However, if you had the money inside of a Roth IRA, Roth IRAs, you don't have to take distributions on. This is part of that Rothification where they're trying to have people, encourage people to save money into Roth accounts and trying to really make those more simple in how they're, I don't know if it's executed or carried out, you know, in the practice of them, because when people used to have money that was, oh, it's a 401k Roth, I got to move it out. They're just trying to make all of those rules much simpler. And so even if you have your Roth inside of your 401k still, you don't have to start taking those minimum distributions. Now that doesn't start till 2024, but it is something that's coming. Now this is a big one. So what happens is the amount of money that you can put into your retirement accounts as people get older, older being closer to retirement. What happened is a number of years ago, the government said, if you're over the age of 50, then you can make a catch-up contribution, which meant that they have limits on how much money you can put in if you're under 50. Once you got over 50, they said, hey, you can start contributing more to your 401k because you're getting closer to retirement. Well, what they're adding here is that if you're over the age of 60, you now have an additional catch-up contribution that you can make. And what the catch-up contribution had been set, it was a static number, it was $7,500 forever. Well, now what they're doing is starting in 2025, they're increasing that for inflation, and they're creating this extra contribution that you can make when you're 60. So let me, to give you an idea, let me see if I can find it in my notes so I can be accurate with it. So to give you an idea, if you are over the age of 60, you're going to be able to start contributing an additional either $10,000 or an additional 50% over the normal catch-up contribution amount is. So for example, if that 7,500 goes up by inflation and it becomes $10,000, at age 60, you'll be able to put your 10 in for that catch-up plus an additional 5 all the way through retirement age. So that could really be a pretty nice way for people as they get close to retirement and usually have a little more dispendable income to really kind of buffer their retirement savings.
So it's basically upping how much you're able to contribute.
That's right. The next piece, which is, so I should probably talk back to the previous slide. I can't remember for sure if we're going to cover it in a future slide, and you're okay to stay where we're at. Those catch-up contributions, if you're over certain income limits, they're going to be forced to go into your Roth. They won't be able to be tax deferred. And so just know that you might be forced into more of this Rothification, try to get it into the Roth. And a lot of times people say, you know, why are they pushing the Roth so heavy?
I was just going to ask that.
Yeah. And the biggest reason is when you look at how government budgets are set, they really look at what current taxation looks like. They don't always plan for future taxation. And when they set the budget, they're looking for how many tax revenue dollars can we generate now? And that helps them to balance the budget. Well, with a Roth, if you remember, the money that you put into it is money that you've already paid tax on. It then grows tax-free. So whenever you take it out, you'd never pay tax on it again. But if I'm the federal government and I'm looking to raise money now for my budget, then if I say you can't defer tax, you have to pay it now because you can't put it into a deferred 401k, it has to go into a Roth. It helps me to balance the budget and create more tax revenue today. Ultimately it's going to hurt, but it creates
They're
more
looking
tax
short
revenue.
term.
That's right. That's right. I've never heard that before though.
Oh.
The other thing is that in the past, you used to only, if you were having contributions go into your 401k as matching contributions from your employer, even if you were putting into a Roth, all of your employer contributions would go into the tax deferred part of your 401k, which meant it wasn't taxable to you. Well, now you have the choice of saying, no, I want to really build my Roth. I'm going to contribute to my Roth, and I want my employer contributions, my matching contributions, to also go into my Roth, which is a change. And what that's going to do is that's going to take whatever your employer was contributing that you weren't paying tax on, and now it's taxable because it's going into the Roth. But you'll have a lot of tax-free income later on. So that's a big area where there might be some strategy that we can employ. Now, remember too, that these are rules that are being changed and they're being offered. This is not, your plan still has to figure out how they're going to administer it. So just because it's available doesn't mean that it's something that your specific plan is going to immediately have available. I think we've got a Q&A up there. So the question is, for the 60-year-old catch-up bump, is that in effect the year in which you turn 60, the month in which you turn 60, or the following year? This is another area where we don't know what the agencies, how they're going to implement it. The way that we're understanding it right now, that it's probably the year in which you turn 60. That's our understanding. But again, it comes down to how the Department of Labor and the IRS are going to want to.
That sounds like a funny way around saying he stumped the chump.
Yeah.
I'm sorry, you don't have an answer.
Is that a fail?
You can blame the government. You don't have an answer.
Yeah, and unfortunately, there's going to be a number of those where until we see what they come back with as guidance, we're not going to know for sure what that looks like. It's another example that, just as an aside, for example, for a number of years, we've had the ability to do what are called qualified charitable distributions from IRAs, QCDs, that's right, from IRAs to charities if you're over the age of 70 and a half. Well, for the first, I think, year, at least 1 year, maybe two, even though that was allowed, the IRS form that you filled out for your tax return had no way for you to account for that. So you had to make a special separate note. And so that's an example of where the law says you can do this, but the agency didn't know for sure how they were going to deal with it. And so then that was their workaround. And that question kind of falls under that same category where we know what it is, but we have to find out how they're going to actually implement it. And so let's talk a little bit about these defined contribution retirement plans and an emergency savings account, that kind of stuff. So this is probably for people, Katie, when you said, hey, I'm not quite that age yet, or I think this is really geared towards people that are younger in their retirement savings years, because what they're trying to do is they're trying to say that you can pull money out of your account in certain emergency situations. Now, it's not tons of money. They're allowing for up to $1,000 for you to be able to pull it out in any 1 year. But it allows for you to take money out if you were younger, maybe not even younger, but if you're in a position where the refrigerator went out or the furnace went out and I need money, then you could take this $1,000. You have to repay it at some point, but it's not taxable at the time when you take it out. It's an emergency distribution. And so when you do that, when you think about it, the reason for that is that many times if I'm just starting to save, I may not have a savings account. And so before I have that savings account, or before I can save for retirement, I want to have a savings account. Well, this is a way to encourage people. Hey, listen, put money into the retirement account, just get started, and then you can have some emergency access to it if you need to. Not necessarily something that many of our clients are probably going to have to worry about unless they're helping their kids get started in life. And they're saying, okay, first job, put in your 401k. And by the way, there's this savings option that's there as well. So let's talk about this. This one gets a little bit, it's a little bit of more detail when we get into what it means. So we were talking just a couple minutes ago about those QCDs, or the qualified charitable distributions. And what this is considered is, there's a lot of words on here that maybe people haven't used before, haven't seen before. Things like charitable remainder unit trust, annuity trust, charitable gift annuities. So what all of those terms mean is it's what's called a split interest trust, or a split interest type of vehicle. So when you think about those words, split interest, The split part means that there's two people that have an interest in that type of an account or that annuity. And so what you do in these types of things, and typically people would do this. Let's say I worked for a company, I had a lot of stock, and I wanted to help my alma mater. I wanted to give it to my college. You could give some of that stock in an annuity, that the value of that stock, when you gave it to the charity, whether it be church or your university, they would sell the stock. Because they're a charity, they would pay no tax on the sale of that stock. Because you gave them the stock, you would get a tax deduction. However, in this phrase, when you say annuity, for example, that would pay you an income for the rest of your life. So let's say you gave them $100,000. You might get $4,000 a year for the rest of your life. That's your interest. You get this income. The split part of that is whenever you die, the balance of that goes to the charity for them to use for whatever they want to use, or however you've designated that. And so that's a split interest where I get a little bit benefit now because I'm getting some tax savings. I'm giving up an asset. I can never get that asset back. It is the charities. That's their interest. But my split interest is that I get this income that can help support me through my retirement. Up until this year, those QCDs could not be used for those types of gifts. The QCD had to go directly to the charity for an immediate use, where now they're opening that up for these split interest types of vehicles. Up to $50,000 can go into that. I'm thinking I'm seeing another question come in.
Say that.
Let's see. So the question is, when you decide to take your RMD, do you need to take equal percentage from Roth IRA and 401k, or can you take it all from one? Yeah, good question there too. So what we'll see here later on is they've changed some of those rules as well. So if you have money inside of a 401k and money inside of an IRA, those dollars cannot count for each other. So let's say that if you look at that total, let's say that you had $500,000 in your retirement accounts, $250,000 in a 401k and $250,000 inside of a traditional IRA. You're going to have to take a minimum distribution from each one of those, because whatever you take out of a 401k cannot offset what you take out of an IRA and vice versa. However, if instead you had $500,000 all inside of one IRA, not even one IRA, let's say two different IRAs, now you can offset those minimum distributions. You can choose, do I take it out of each or do I take it all out of one? You get to choose. So when it's like kind, you can have them offset. The Roth part of that, with some of the new changes now, you're not going to have to take those minimum distributions out of Roth. And so the Roth, you can completely disregard in that calculation. It is only those traditional or tax deferred vehicles, but they did not change it to where they kind of offset each other. The 401k has to account for itself. IRA has to account for itself. So let's talk a little bit about this next piece. So this again is an opportunity for people that maybe don't need all of their money or all of their income right now. And maybe they're trying to defer some of those minimum distributions. So what happens is, and I'll give an example. Let's say that you're a business owner and you're selling your business, and you know that you're selling it at RMD age. And you know that for the next 5 years, you're going to be having money come in from the sale of this business. It's going to be bought out over time, which means that you're going to have a lot of income for the next 5 years. At the same time that you have to take your minimum distributions. So you're thinking, man, how do I really want to pay all that tax? What qualified longevity annuity contracts, or QLACs, do is they allow people to say, I'm going to take $200,000 up to $200,000, move it into this type of a vehicle. And now I don't have to use that in my RMD calculation. I won't get that money until later. It's that longevity piece. And the concept there, the reason that it's there is the IRS doesn't want people, if they're going to have a really long life, they don't necessarily want them pulling all their money out and going broke. And so what these do is they set a specific time well into usually it's in your mid 80s, where at that point in time is when you can start taking the money out. Until that, it sits in this annuity contract, and it's really meant to be this kind of longevity play. But it provides some tax advantages if you know, like at RMD age, I'm going to have a lot of income and I don't need this money. It creates an opportunity for people to defer some of those things longer. Now, this one's an interesting one. This goes back to a bit of that, the concept around how do we get younger people starting to save, or people, I shouldn't say younger, people that haven't been saving, how do we get them saving? And so you'll notice that in the year 2025, as companies or businesses start adopting new 401k plans. So also you see on here, it says 403b. Know that 403b is kind of like the brother or cousin to a 401k, except 403b is for nonprofit organizations. 401k is more for businesses. And so when you open those starting in 2025, there's going to be an automatic enrollment for where companies are going to say all employees that are here are going to start putting in 3% into their salary. Now there are ways that employees can opt out. It's not like you're forced to, but it's going to have to be, I tell them no, instead of I tell them yes. And again, this goes back to how's it going to be implemented. This is just something that now is created. So we'll have to see how it's implemented, which is why you'll see some of these things starting later on in future years. Because basically what they're doing is they're giving the IRS and Department of Labor 2 years to figure out how are you going to get this.
So is this going to be kind of like Real ID, and every year they say, okay, 2 more years.
Yeah,
You have a 2 more year extension.
Usually not. Usually not.
So we really need to figure that out.
Yeah. Usually you need to pay attention, because usually they try to stick pretty hard to that. And what you'll see also is that there's other ways that there in future slides here, we're going to talk, there's other things that can happen with how those matching contributions happen as well. It looks like we have another question. And so the question is, on the previous slide, when we were talking about those qualified longevity annuities, the question is, can you choose how that $200,000 is invested? And no, there are specific, now you can choose which company you take it with, but there are specific rules and structure around those annuity contracts to qualify. And so once you say, I want that QLAC or that qualified longevity annuity, you're forced into those parameters. And so, no, there's not a lot of choice there. So here we go with some of those interesting matching contribution things. So I think that this kind of goes to the changing landscape. I was calling it Rothification before, because there's a lot of Roth to it, but I think it's really Congress trying to look and say, what are the things that we can do to help people become more financially secure? And how can we encourage the behavior that we want while encouraging them to save for retirement? And so here you'll notice that it talks about matching employee student loan payments inside of a retirement account. So, if you've got somebody that maybe is still paying off those student loans and they're like, man, I don't have any money to save into my retirement account because I'm putting all this money to my student loans. This is a way that employers now can offer them this benefit towards retirement, even though they're paying off their student loans instead of making those 401k contributions. Now, the interesting part here, though, is you'll notice that it talks about, it just says, these student loan payments. If we were being technically correct, it would say qualified student loan repayments. And there are rules around what loans qualify, what loans don't qualify, what payments qualify. And so this is another area where we're going to have to see, how is this executed? As an employer, how am I going to know, did you pay off those student loans? Did you make those payments? And did it go to the right one, the wrong one? So it's going to be a little bit messy, but I think the concept is kind of interesting that we can do that. And especially I think about for us with some of our younger employees, that's tough when you're starting out and, you're kind of just out of school and you're figuring out, how am I going to pay for my own apartment or my own car, pay off these student loans, and all of a sudden you've got this stuff and you don't have that discretionary income. And so you can lose some very important years in the beginning of your career in saving for retirement. So this is a really good way to kind of help in that regard, I think. This is probably the biggest, in my mind, one of the biggest changes that means a lot.
And when I read this, it's like, Want, we want.
Yeah. Welcome,
I
welcome,
kinda-
Charlie Brown.
I kind of glaze.
Yeah, for sure. So you mean up until this point?
I was right on.
Yeah, dead on. So what happens with this is, if you're familiar at all with the 529 plans, what those are is those are ways for parents to save for their children's education, or grandparents, or even students themselves. So it's just a way to save for education. If you put them into a 529 plan, there are tax benefits to doing that. Because, so what happens is, anytime the government gives you a tax benefit, know that there's a consequence to that tax benefit. So for example, in a 529 plan, you get the benefit that you don't pay taxes on whatever that account earns, as long as you use it for education. If you don't use it for education, then all of a sudden you're
Hit
paying,
with the bill.
yep, that's right, taxes plus penalties. And so what was hard was parents trying to figure out, how much should I save in this 529, because I don't want to end
Well,
up
if they don't wanna go to
overfunding it.
school.
Exactly. If I have a child that wants to go into the military, for example, well, when they get out of the military, many times their education's helped to be paid for. So do they even need the 529 plan? And so it's really hard to balance that. But what they've done now is they're allowing for 529 plans to be able to roll into Roth IRAs for,
Mhm.
now it has to be for the beneficiary. So let's say that I had a 529 plan for Grace, our youngest, and Grace doesn't need the money when she goes to school. I can roll that money into a Roth IRA, but it's a Roth IRA in her name.
Sure.
It's not like I can say, oh, well, good, now Sarah and I have more money to retire on. It goes into her name, but at least it gets it out of the 529 without those
The
taxes and penalties. But the limits here are, you can only do up to $35,000 per beneficiary lifetime.
Mm.
And you can only do Roth IRA contribution limits per year. So it's not like I can say, oh, well, she just graduated college, she's not going to use that money, let me put it all into a Roth. You're limited to whatever those Roth contribution limits are for the year. That's the maximum amount you can put in, and you can only do up to $35,000 lifetime. But at least there's a way to get some of that money.
Yeah, because
out.
35,000 is like a semester of
It seems like
college.
it. It seems like it. Yeah, yeah, yeah. It certainly can seem like that. So now let's open it up and see, are there any questions that we want to have for kind of Stump the Chump? Pull up the, yeah, I'm gonna go to the stop. All right, the floor is open. So remember, as we go through this, any questions that you have, sometimes we've got people come in with questions regarding the market and where's the market going. There can be questions regarding kind of the topic we just talked about. We're open to anything that comes to mind.
Maybe they want to stump this chump, maybe. So if you have a unrelated like shopping question,
so-
you won't stump me, but
Yeah, not in that category at least, right, Katie? Or how about new mom questions, right?
yeah, no, you might stump me on that.
No. Yeah, and so I know that sometimes people have, like I said, questions that'll come in, especially around the markets. Yeah, I see now a question coming in regarding inflation and where we see inflation going. So from our perspective, when we look at inflation, we do see things starting to calm down a little bit. We anticipate that let me back up and talk about why do we see things calming down a little bit. So we see the labor market especially starting to change. We've had a lot of conversations around how many people are at work and how many people are earning more money and spending more money and all that kind of stuff. But what we're starting to see is the labor market is getting a little bit more free. You've got some companies that are laying some people off, people that are starting to say, you know what, that whole couple of years of my semi-retirement when I was in COVID, I now need to kind of change that a little bit. And so we're seeing the labor market loosen up a little bit, which means that you'll see labor costs start to come down as well. You'll also see it's kind of like supply and demand, that where the higher the demand and the lower the supply of people is going to drive those prices up. And so when I combine that with the fact that we're seeing that people's their free money that they have, their savings, the Federal Reserve has a measure that they call excess or savings. And so what they do is they calculate and say, here's about how much money we think people should have in excess, in savings across the country. Anything over that is excess. Anything under that is deficit savings. And what has happened is over the last couple of years, as people were not spending as much money and as there was a bunch of stimulus money being put into the economy, we saw excess savings that was huge. I mean, it was huge dollar amounts. That's savings over and above what people typically would have. Over the course of the last year, we've seen those excess savings come down dramatically as people were spending, and we're actually seeing some pockets of deficit savings now. And so what will happen is people spend less money, they'll buy less things, which will start driving down prices, which will start to see inflation come down a little bit. So our anticipation is obviously there's lots of people that are looking at it, but our anticipation is that we probably see inflation come down here over the course of the next handful of months. Another question back to qualified longevity annuities. Question around, what kind of return can you get on those dollars? Those are usually put into fixed types of accounts that have very low return. When I say low return, that's probably a poor choice of words. It's not something, because you can't choose where it's invested. It's not like you can put it into the stock market or the bond market. Each provider is going to have a little different nuance to what that looks like. But it's not, you're not going to be seeing, 8 to 10% returns. It's going to be something that's going to be pretty low single digits. Some of them really don't even have much of a return. It's more around, how do I defer the money, and then when I go to take it out, that's when I start receiving any sort of return on it. Another question came in around, is there a chance that the $35,000 limit on the 529 excesses or excess funds will increase in the future? There's always that possibility. They did not write it into the legislation. Usually what will happen if there's going to be those increases, they'll tie it to some sort of cost of living increase or something like that. And so what I could see happening is that they set it at 35,000. And many times they do this just to see how new legislation kind of works and does it do what we want it to. And so they'll set it at the 35,000. They'll allow it to go for some period of time. And then they'll realize, what, we need to change that and either increase, decrease it. And so I could see that happening, but I wouldn't anticipate that anytime in the near future.
If I remember right, on one of the last episodes of the Retirement Readiness podcast that we recorded together, I asked you a question about solar panels, and you said that I did stump you about that. So, are you open to a solar panel talk?
We can't talk solar panels. I would not say that I'm the expert still,
okay.
But yeah. When I don't remember when that episode's going to air. Is that episode coming out in the next couple of weeks?
Next couple of weeks, yeah.
Yes. Yeah. So look for that. So we veered a little bit from our knowledge base of financial advising and went to solar panels there for a while. Another question came in around the qualified charitable distributions. And it says, does your QCD have to be taken out before your RMD comes up? And so no, what happens is with a qualified charitable distribution, it's treated it's treated on one hand like its own separate distribution, but on the other hand, it's treated kind of like an RMD. And what I mean by that is you can choose to take a qualified charitable distribution out, even if you've already satisfied your RMD for the year. You can do up to $100,000 each year through these qualified charitable distributions. Now, what will happen though is if you have not satisfied your RMD for the year, the qualified charitable distribution will actually count as part of that RMD being satisfied. So let's say this year you want to give $10,000 to church and your minimum distribution is $18,000. What you could do is you can say, I'm going to do a qualified charitable distribution to church for $10,000 like I wanted to, and then I'm going to take the remaining $8,000 for myself and pay tax on that.
So as people hit that QCD age, is that how most people give to church? Is they do it yearly rather than monthly?
Yeah, and so I wouldn't say most, but it's what we'd recommend people do. So what happens is, especially under current tax law, what we find is that a lot of people don't have high enough deductions to get over the standard deduction. So many of our clients are just taking what's called the standard deduction. What that means is that the amount that you're giving to charity, you're not counting as a deduction off your tax return because you're taking the standard deduction. And so what would happen is let's say my minimum distribution was $10,000. If I decided I'm going to take $10,000 out, I'm going to turn around and write a check to church. Then when I take it out, I have to pay tax on it. When I give it to church, because I'm taking the standard deduction and not itemizing, I don't get any benefit for the $10,000 I gave to church. So I'm just paying tax on that distribution. What the qualified charitable distribution allows me to do is it allows me just to get it to church, never shows up on my tax return. So I still take my standard deduction. It still goes to church, but I never had the first part of that where when I took it out, I had to pay tax on it. So not everybody does it at age 70 and a half, but we recommend if you've got IRA money and you like to give to charity, do it through a qualified charitable distribution instead of writing a check.
All right. Anybody have any last questions? Looks like we might have answered them all.
As we're wrapping up, it's a good opportunity for us you mentioned the Retirement Readiness Podcast. If you're not aware of it, we release those every 2 weeks. We've got the next one, is it next week? I think being dropped.
Yep.
And so, look for that. You can find us on YouTube with those if you prefer the video version, but we're also on your different podcast streaming.
Apple Podcasts, Spotify Podcasts.
And if you're wondering, how do you get it? Usually we're posting it to our Facebook, on our website, or on our LinkedIn. And we'll have links there that you can click on it. And if you get there, you can subscribe to it. So then you're notified when they come out, right?
Yep, absolutely.
And so Stump the Chump, we're hoping to do on a quarterly basis is the plan right now. And the idea here is that we'll probably pick a larger topic, have some prepared remarks around that, but then really have the ability for you to come in with whatever questions you have.
About that topic or just in general?
Yep, in general. As we said at the outset, as we were bantering a little bit, I do like sandwiches. So if you have any questions regarding sandwiches,
You are not a chump.
I am not a chump there. So we really appreciate you joining us today. It was really good seeing you.
Until next time, be well.